welcome to 3.0 TV. I'm your host Ruchi Sharma, and today we are going to talk about institutional crypto custody and how banks are housing digital assets. But before moving ahead, please like and share our videos, subscribe to our channel and press the bell icon to get instant updates. Despite the crypto winter, banks are now dipping their toes in crypto custody sector in anticipation of institutional investors adopting cryptocurrencies to hedge the risk from traditional finance. Until 2020, most of the crypto market action was largely driven by retail enthusiasm. It was only around August 2020 that institutions started to participate meaningfully in this asset class. As the United States Federal Reserve unleashed trillions of dollars of liquidity into the market during the COVID-19 pandemic, retail and institutional investors jumped onto the cryptocurrency bandwagon. While crypto loyalists claim large-scale institutional adoption over the last couple of years, the entire asset class is only around $1 trillion in size. That is quite small when compared to the gold market of $11 trillion and the bond market of over $100 trillion. There is still a long way to go for the institutional adoption of crypto and blockchain-based digital assets. Some institutions, particularly top-tier banks and fintech firms, have started building capabilities to offer digital asset products and services to their clients. This is because banks and fintech firms are starting to see cryptos, NFTs and other digital assets as a systemically important asset class. Not offering these products and services to their clients would be leaving a pot of money on the table. These clients that banks serve vary from hedge funds, asset managers, family offices, corporations, small and medium enterprises to even retail customers. However, it is easier for banks to serve their institutional clients first, as they would have to go through lower regulatory hurdles than when serving a retail audience. Financial institutions have focused on a few capabilities that have lower regulatory hurdles, such as custody and data analytics within the crypto space. While this is largely true with banks, fintech firms have taken a more retail-friendly approach. For instance, Revolut offers crypto services to its customers. What is digital asset custody? Digital asset custody is the process of storing cryptos, NFTs, and other forms of digital assets safely and securely. A new user typically creates an account on an exchange like Coinbase or Binance and buys cryptos there. These cryptocurrencies sitting in their exchange accounts are under the custody of the exchange. However, if a user wants to take custody of their digital asset holdings, they would typically move them to a wallet like MetaMask or Phantom. This is called self-custody. This can be intimidating for users as it requires remembering a private key. To date, about 4 million bitcoins have been lost due to owners losing their private keys. Self-custody may not be a solution for everyone. At the same time, institutions that provide custodial services to clients have had their dark days too. For instance, Celsius, a centralized crypto lending platform, held custody of its client assets and have had troubles servicing its customers. As markets hit peak crisis through the Terra episode, Celsius wasn't able to return the crypto assets of their customers due to poor liquidity management practices. Therefore, institutions offering custodial services must have high risk management standards to ensure their clients' digital asset holdings are safe and liquid. How do financial institutions approach digital asset custody? Banks have been custodians of retail and institutional money for decades and have done a pretty good job. Particularly after the Great Depression, the self-custody of assets were considered too risky, and that led to the rise of banking institutions. According to the Bank for International Settlements, reporting banks across the world held over $101 trillion in assets in 2022. The US accounted for about 20% of that at just over $20 trillion. This demonstrates that banks have historically been trusted with holding custody of both institutional and retail assets. As a result, it is only natural that institutional and retail investors rely on banks to offer digital asset custody solutions. However, unlike custody of conventional money, digital assets require a new set of considerations from a bank. So what are banks' custody considerations? Banks looking to set up digital asset custody typically look at two broad approaches: building and buying capabilities. Banks can choose to organically build custody capabilities. For instance, Nomura's Komainu and Standard Chartered's Zodia custody platforms are examples where major banks use their in-house technology to build digital asset custody solutions. These banks can use these solutions for their own clients and offer custody platforms for other banks to use too. However, banks are not in the technology business. When a bank chooses to buy custody capability, it may just acquire a custody provider or the technology from an external vendor. Once they acquire the technology capability from a vendor, they can offer custody services to their clients. Other alternatives are investing in a digital asset custody provider for long-term strategic synergies and/or partnering with the custody provider. In summary, they will look into inorganically created custody capability through strategic investment and acquisitions. Where a bank chooses to buy or inorganically bring in the digital asset custody capability from an external vendor, there are certain product considerations, like regulatory approvals. Banks must seek regulatory clarity and ensure compliance before choosing a custody provider. The custody platform under consideration must demonstrate compliance with regional regulatory policies around crypto custody. The Office of the Comptroller of the Currency in the US and the markets in crypto. Assets in Europe drive custody regulations for their respective regions. As custody providers, banks will hold private keys on behalf of their clients. This adds additional operational risk, and banks must demonstrate that suitable controls are in place to ensure safekeeping. Blockchains and assets supported. When banks look at a potential custody platform, one of the key considerations would be the blockchains that the platform supports. Often these custody solutions support blue-chip assets like BTC and Ether. However, with more chains growing in stature, user base and transaction volume logged, clients may demand custody support for chains like Solana, Avalanche, and others. Also, it may not be enough for custody platforms to just support crypto anymore. NFTs have started to make a mark, particularly within the art space. The most expensive NFT yet, the merge was sold for $91.8 million. As a result, private banking and wealth clients of banks may soon demand support for NFT custody too. This would be a key consideration for a bank looking to choose a custody platform. Last year, in particular, saw an influx of financial institutions incorporating support for crypto asset custody. For example, Bank of New York Mellon or BNY Mellon announced in February 2021 plans to hold, transfer and issue Bitcoin and other cryptocurrencies as an asset manager on behalf of its clients. Following in BNY Mellon's footsteps, Banco Bilbao Vizcaya Argentaria started in June 2021 that it would offer Bitcoin trading and custody services in Switzerland. Then, in October of last year, US Bank, the fifth largest retail bank in the United States, announced the launch of its cryptocurrency custody service for institutional investors. Recently, Nasdaq also announced to launch crypto custody services as well. It's also important to point out that traditional banks have started working closely with crypto custodians and sub-custodians to introduce custody for digital assets. The partnership between traditional banks and sub-custodians is an important one. While sub-custodians are helping traditional financial institutions participate in the digital asset ecosystem, crypto custodians like Gemini and Coinbase are also playing an important role. Banks will eventually brand custody solutions as their own, which will be powered by Gemini, Anchorage, BitGo, or some other established crypto custodian. Moreover, digital asset infrastructure providers are also helping bridge the gap between traditional banks and the world of crypto. For example, Fireblocks has partnered with BNY Mellon to enable its digital asset custody solution. Custody is a lucrative yet crowded market in the crypto space, with institutional custody providers fetching multi-billion-dollar valuations. Crypto wallet and custody firm Ledger clinched a $1.5 billion valuation in June 2021, while Anchorage closed a $350 million funding round at a $3 billion valuation in December 2021. The rising demand for digital assets from institutional investors will result in traditional financial institutions working hand in hand with crypto custodians and service providers. However, as regulatory frameworks become clearer, we should see more innovative digital asset sub-verticals being embraced by financial services. Well, that's it in today's episode. We will meet again with exciting stories about the Metaverse. Till then, keep watching 3.0 TV, like and share our videos, subscribe to our channel and press the bell icon to get instant updates. This is me, Ruchi Sharma, signing off. Have a great day.